Tesla's downfall. The electric car giant's struggle for survival. Over $800 billion evaporated. Tesla has lost more than 50% of its stock value in less than 6 months. Why is the electric car giant, once unstoppable in its success, now facing the risk of collapse? The numbers don't lie. Tesla has evaporated nearly $800 billion in market capitalization, an enormous figure not just for an electric car company, but for any company at all. And it doesn't end there. Tesla's stock dropped more than 15% in just one day, and then fell another 3% after hours. Investors who once saw Tesla as a cash cow are now facing big questions about the company's future. This dramatic decline represents one of the most significant market value losses in corporate history. To put this in perspective, the $800 billion that vanished from Tesla's market cap exceeds the total GDP of many countries, including Switzerland, Poland, and Sweden. It's equivalent to the combined market value of Ford, General Motors, Toyota, and Volkswagen at their peak. The speed of this collapse has sent shockwaves through Wall Street, with many analysts struggling to comprehend how a company that seemed invincible just months ago could fall so dramatically. The situation becomes even more concerning when we examine the day-to-day volatility. A 15% single-day drop followed by another 3% after hours represents extreme market pessimism. These kinds of rapid movements typically signal deep structural problems rather than temporary setbacks. For long-term Tesla investors who bought in during the company's meteoric rise, these losses are particularly painful. Many retail investors who believed in Elon Musk's vision have seen their portfolios devastated, with some reporting losses of 60% or more on their Tesla positions. But China is a different story. A 10% tariff on Chinese imports went into effect at midnight. China retaliated immediately with a 15% tax on U.S. coal, 10% on U.S. crude oil, and large displacement cars and pickup trucks. Recently, China has raised the import tax on electric vehicles from countries outside of China, including Tesla. According to a report from the China Customs Administration in December 2024, the tax on Tesla's products has increased from 15% to 25% on high-end models like the Model S and Model X. This increase in taxes raises production costs, especially as Tesla relies on imported parts from other countries such as the U.S. and European nations. The timing of China's tax increase couldn't be worse for Tesla, coming amid already declining sales and increasing competition. The Chinese government has made no secret of its desire to promote domestic EV manufacturers, and these tariff increases appear strategically designed to disadvantage foreign competitors like Tesla. Industry analysts estimate that these new tariffs will add approximately $5,000 to $8,000 to the price of imported Tesla vehicles, a significant amount in the price-sensitive Chinese market. Tesla is facing difficulties as its high-end models become more expensive and less accessible to Chinese consumers. For example, the price of the Model 3 is around $43,000 while the BYD HN EV costs only $30,000. BYD and NIO are dominating the market with lower prices and comparable features. In 2023, BYD sold over 1.2 million vehicles, capturing 25% of the electric vehicle market in China, while Tesla only sold 350,000 vehicles. The price differential has become impossible to ignore for Chinese consumers. When comparing feature for feature, Chinese domestic brands now offer equal or superior technology at significantly lower price points. The BYD HN EV, at just $30,000, provides similar range, acceleration, and smart features as Tesla's Model 3, but at a 30% discount. This value proposition is proving irresistible to Chinese consumers, who are increasingly viewing domestic brands as the smarter choice rather than status symbols from America. The sales figures tell a compelling story. BYD's 1.2 million vehicles sold in 2023 represents a year-over-year growth of nearly 60%, while Tesla's 350,000 units reflect a modest 5% increase in the same period. This widening gap indicates that the trend is accelerating rather than stabilizing. NIO, another Chinese competitor, has seen its sales triple in the past 2 years, with its premium models now outselling Tesla's Model S in many Chinese provinces. The company's battery swapping technology, which allows drivers to exchange depleted batteries for fully charged ones in under 5 minutes, has proven particularly popular in dense urban areas where home charging isn't always feasible. The shift in consumer preferences in China is becoming increasingly strong, with consumers prioritizing domestic vehicles that are more affordable. If Tesla doesn't adjust its pricing strategy and improve its technology, it could lose its position in the largest electric vehicle market in the world. China represents approximately 40% of the global EV market, making it absolutely crucial for any company with ambitions of EV leadership. Losing ground in China doesn't just impact Tesla's current sales, it threatens the company's entire growth narrative. Chinese consumers are not just choosing domestic brands for price reasons. Recent surveys indicate that 68% of Chinese EV buyers now rate domestic brands as equal or superior in quality to foreign competitors. This perception shift represents a complete reversal from just 5 years ago when foreign brands were universally seen as higher quality. Technological innovations from companies like BYD and NIO, including advanced battery technology, autonomous driving features, and integrated entertainment systems, have convinced consumers that Chinese EVs are now at the cutting edge of the industry. Tesla's market share in the U.S. has dropped significantly from 79% in 2020 to just 54% in 2023. In Europe, the situation is even worse, with sales dropping by 30%. This decline is not only due to intense competition, but also because of Elon Musk's political views, whose controversial statements have eroded customer loyalty. Tesla is no longer the only symbol of innovation. Rivals are steadily taking over the markets that Tesla once dominated. The U.S. market, once Tesla's unassailable stronghold, is showing clear signs of vulnerability. The drop from 79% market share to 54% in just 3 years represents one of the most dramatic market share collapses in automotive history. New entrants like Rivian, Lucid, and established manufacturers like Ford with its Mustang Mach-E and F-150 Lightning have carved out significant portions of the market. Consumer Reports surveys indicate that 38% of potential EV buyers who previously considered Tesla now list other brands as their first choice. The European situation is particularly alarming for Tesla investors. The 30% sales drop comes despite the overall European EV market growing by 15% during the same period. This indicates Tesla isn't just failing to grow with the market, it's actively losing existing customers. Volkswagen Group's aggressive EV push, with models like the ID.4 and Audi e-tron, has resonated strongly with European consumers. Similarly, Renault-Nissan's affordable EV offerings have captured the entry-level market that Tesla has never properly addressed. Tesla is gradually losing its connection with old customers, and this is creating a gap that competitors can fill. The political controversies surrounding Musk have damaged Tesla's image, causing many customers to turn their backs on the company. A recent consumer sentiment analysis revealed that 42% of former Tesla owners cited disagreement with company leadership as a primary reason for switching to competitor brands. This represents a fundamental shift in how consumers view the company, no longer just as a car manufacturer, but as an extension of Musk's personal brand and political stance. The loyalty erosion is particularly pronounced among Tesla's original demographic, environmentally conscious, tech-forward consumers who tend to lean politically liberal. These early adopters were crucial in establishing Tesla's brand cachet and driving word-of-mouth recommendations. Now, many of these same customers report feeling alienated by the company's evolution and Musk's increasingly divisive public statements. One former Tesla owner in Portland, Oregon told reporters, "I bought a Tesla because I wanted to support sustainable transportation and innovation. Now I feel like I'm supporting something else entirely." As Tesla's stock continues to plummet, investors are worried that Tesla may not be able to overcome this crisis. One of the main reasons for the sharp decline in Tesla's stock is the loss of investor confidence. They no longer see Tesla as the cash cow, but as a company facing numerous challenges. Not only are there issues with stock prices, but Tesla's financial reports are also raising concerns about the company's ability to maintain profitability. The investor exodus has been led by institutional investors, with major funds reducing their Tesla positions by an average of 22% over the past 2 quarters. BlackRock, once one of Tesla's largest institutional shareholders, has decreased its position by nearly 15% since January. Similarly, Vanguard Group has reduced its Tesla holdings by approximately 18%. These moves by sophisticated institutional investors often precede broader market sentiment shifts and suggest deep concerns about Tesla's fundamental business outlook. Wall Street analysts have been revising their price targets downward at an unprecedented rate. Morgan Stanley, long bullish on Tesla, recently lowered its price target from $310 to $220, citing increasing competition and margin pressure. Goldman Sachs analysts expressed concern about deteriorating fundamentals in key markets and questioned whether Tesla could maintain its premium pricing in an increasingly crowded EV landscape. The consensus earnings estimates for Tesla have been revised downward by 35% for the upcoming fiscal year, reflecting widespread pessimism about the company's near-term prospects. Specifically, production costs are increasing while demand from the market is declining. Maintaining high production levels without being impacted by tax costs or the effects of international policies is a huge challenge for Tesla. The company's much-vaunted production efficiency advantages appear to be eroding as raw material costs for batteries have increased by approximately 30% over the past 18 months. Lithium, nickel, and cobalt, all essential components for Tesla's batteries, have seen significant price volatility, making cost projections difficult and eating into profit margins. Tesla's production challenges extend beyond raw material costs. The company's ambitious expansion plans, including new gigafactories in Berlin and Texas, have faced delays and cost overruns. The Berlin facility, initially projected to cost $1.1 billion, has seen its budget balloon to over $5.8 billion according to internal documents leaked to German press. Similarly, the Texas Gigafactory has faced construction delays and regulatory hurdles that have pushed back full production capacity by nearly 18 months. These delays are particularly problematic given the accelerating competition in the EV space. Labor costs represent another growing concern for Tesla's production economics. While the company has historically maintained non-unionized workforces, pressure is mounting in multiple jurisdictions. In Germany, powerful labor unions have already established a foothold in the Berlin Gigafactory, potentially driving up labor costs. In the U.S., the United Auto Workers Union has publicly stated its intention to organize Tesla's domestic facilities following its successful negotiations with traditional automakers. Any significant increase in labor costs would further erode Tesla's already thinning margins. If you want to know if Tesla can overcome this crisis and how Elon Musk can maintain his position in the electric vehicle industry, don't take your eyes off this analysis. Fascinating insights and deep analysis are waiting for you ahead. Tesla's challenges extend beyond just market competition and production costs. The company's reliance on regulatory credits has become increasingly problematic. In previous years, Tesla generated significant revenue by selling regulatory credits to other automakers who needed them to comply with emission standards. However, as more traditional automakers develop their own EV programs, their need for Tesla's credits has diminished. In the most recent quarter, revenue from regulatory credits fell by 49% compared to the same period last year, eliminating what had been a reliable source of high-margin income. The company's autonomous driving technology, once considered its ace in the hole, has also faced setbacks. Despite Musk's repeated promises of imminent, full self-driving capability, the technology remains in beta testing and has faced regulatory scrutiny following several high-profile accidents. The National Highway Traffic Safety Administration has opened multiple investigations into Tesla's autopilot and FSD systems, potentially threatening what Musk has described as Tesla's most valuable technological asset. Competitors like Waymo and Cruise have meanwhile made significant advances in their own autonomous driving systems, eroding what was once Tesla's clear technological lead. Tesla's energy business, which includes solar panels and battery storage systems, has also underperformed expectations. Once touted as a potential growth engine that would complement the automotive business, the energy division has struggled with production delays, installation problems, and fierce competition from specialized solar and battery companies. The much-hyped solar roof product has faced particular difficulties, with installations running far behind schedule and costs significantly exceeding initial estimates. For Tesla to navigate through this crisis, several key changes may be necessary. First, the company needs to seriously reconsider its pricing strategy, particularly in competitive markets like China. While maintaining premium pricing has preserved margins, it has come at the cost of market share. A more flexible pricing approach, potentially including lower-cost models specifically designed for price-sensitive markets, could help Tesla regain momentum. Second, Tesla must accelerate its product development cycle. The Cybertruck's repeated delays have damaged the company's reputation for innovation, while competitors have rapidly expanded their product lineups. The promised $25,000 Tesla model, which could open up entirely new market segments, remains conspicuously absent from the company's near-term production plans. Third, Musk himself may need to reconsider his public persona and its impact on the Tesla brand. While his maverick style and outspoken nature were once assets that differentiated Tesla from stodgy automotive competitors, his increasingly divisive political statements appear to be alienating core customer demographics. A return to focusing on Tesla's mission of sustainable transportation could help repair relationships with environmentally conscious consumers who formed the company's original base. Despite these challenges, Tesla retains significant strengths. Its supercharger network remains the most extensive and reliable EV charging infrastructure globally, a crucial advantage as charging anxiety continues to be a major barrier to EV adoption. The company's vertical integration, particularly in battery production and software development, provides cost and performance advantages that competitors struggle to match. And despite recent erosion, Tesla's brand still carries tremendous value and recognition among consumers worldwide. The next 12 to 18 months will be critical in determining whether Tesla can overcome its current challenges and return to a growth trajectory, or whether the company's early success will be remembered as a brief moment in automotive history before traditional manufacturers and new competitors claim the EV future. For investors, customers, and the broader automotive industry, Tesla's fate represents more than just the success or failure of a single company. It may well determine the pace and direction of the global transition to electric mobility. Hashtag Trump warns BRICS, threatens 100% tariff if they ditch the dollar. Donald Trump has just warned BRICS nations they ditch the U.S. dollar in international trade. America will impose a 100% tariff on their goods. But what's really behind this threat? China is executing a bold strategy, reducing its holdings of U.S. Treasury bonds while dramatically increasing its gold reserves. Could this shake up the global financial system? Let's dive in. Recently, in early 2025, President Trump made a strong statement. If BRICS countries continue to bypass the U.S. dollar in international transactions, they will face a 100% tariff. This is a bold move, especially against China, which is actively working to reduce its dependence on the U.S. dollar. For years, the U.S. dollar has maintained its position as the global reserve currency, enabling the U.S. to borrow easily and dominate international trade. However, BRICS nations led by China are taking powerful steps to change this dynamic. Can the U.S. maintain its financial power as these nations move away from the dollar? Trump's threat represents one of the most aggressive economic stances taken by any U.S. administration against the BRICS coalition. The proposed 100% tariff would effectively double the price of all imports from BRICS nations, potentially triggering a global trade war of unprecedented scale. Economic analysts have estimated that such tariffs could reduce global trade by as much as 8% within the first year of implementation, creating ripple effects throughout the world economy. The announcement sent immediate shockwaves through financial markets, with the Dow Jones Industrial Average dropping over 800 points in the day following Trump's statement. The timing of Trump's threat coincides with accelerating efforts by BRICS nations to create alternative financial systems that bypass the U.S. dollar. In recent months, the BRICS New Development Bank has expanded its lending operations by 40%, providing member countries with dollar-free financing options. Additionally, the BRICS Contingent Reserve Arrangement has grown to over $250 billion, creating a substantial alternative to IMF funding that has traditionally required dollar-denominated repayments. These institutions represent concrete steps toward a multipolar financial world rather than mere rhetorical challenges to U.S. dominance. Trump emphasized that if BRICS countries refuse to stick with the dollar, it will not only be a financial loss for the U.S., but could also cause the dollar to lose its global dominance, shaking the entire international financial system and challenging America's economic power worldwide. The implications of such a shift would be profound and far-reaching. The dollar's reserve currency status has allowed the U.S. to run persistent trade deficits without facing the normal economic consequences, a privilege economists refer to as exorbitant privilege. If this status erodes, the U.S. would likely face higher borrowing costs, reduced fiscal flexibility, and diminished global influence. The threat of 100% tariffs reflects growing anxiety within U.S. policy circles about the dollar's future. Internal Treasury Department analyses, recently leaked to financial press, suggest that even a 15% reduction in the dollar's share of global reserves could increase U.S. government borrowing costs by 0.8 to 1.2 percentage points. With the national debt exceeding $34 trillion, such an increase would add hundreds of billions in annual interest expenses to the federal budget. This financial reality explains the increasingly aggressive stance toward nations seeking dollar alternatives. China is rolling out a bold financial strategy to counter U.S. pressure. They are sharply reducing their holdings of U.S. Treasury bonds, one of the assets the U.S. uses to finance its national debt. China, once one of America's largest creditors, is now shifting towards increasing its gold reserves. In 2024, China added another 250 tons of gold to its reserves. This is a crucial move, not only helping China reduce its reliance on the U.S. dollar, but also protecting its national wealth from global financial volatility. The scale of China's pivot away from U.S. treasuries is remarkable. From a peak holding of $1.3 trillion in 2013, China has reduced its treasury portfolio to approximately $770 billion as of the latest reports. This represents a reduction of over 40%, executed gradually to avoid triggering market panic. Simultaneously, China's gold reserves have grown from approximately 1,000 tons in 2015 to over 2,300 tons today, making it the world's fifth largest national gold holder. Industry experts estimate that China's actual gold holdings may be significantly higher, as purchases through proxies and unreported acquisitions could add another 1,000 to 1,500 tons to this official figure. The strategy extends beyond just accumulating physical gold. China has also been developing its Shanghai Gold Exchange as an alternative to the London and New York gold markets that have historically dominated global price setting. Trading volumes on the Shanghai Exchange have increased by 300% over the past 5 years, and the exchange now allows settlement in yuan rather than dollars. This creates a complete pathway for nations to conduct gold-based trade without touching the dollar system at any point. Precisely the scenario that has prompted Trump's aggressive response. But what happens if gold actually replaces the U.S. dollar in international transactions? China's gold accumulation is not just a reaction to U.S. policies, but a long-term strategy to protect its financial stability in the face of international tensions. By reducing its holdings of U.S. Treasury bonds, China is building a strong defense against economic instability and financial sanctions from the dollar. The potential consequences of a gold-centered international monetary system would differ dramatically from the current dollar-based regime. Gold's limited supply would likely constrain global liquidity, potentially slowing economic growth, but also reducing the risk of debt bubbles and financial crises. Nations would be unable to finance large trade deficits over extended periods, as physical gold reserves would need to flow to creditor nations, a natural balancing mechanism absent in the current system. For countries like the U.S. that have grown accustomed to persistent trade deficits, this transition would require painful economic adjustments, including reduced consumption and increased domestic production. A return to gold-centered trade would also shift geopolitical power toward nations with large gold reserves and gold production capacity. Russia, as the world's third-largest gold producer, would see its international influence enhanced despite Western sanctions. Similarly, South Africa's position within BRICS would be strengthened by its substantial gold mining industry. These shifts help explain why BRICS nations have been particularly receptive to gold-based trade proposals, seeing in them an opportunity to rebalance global economic power away from Western dominance. Impact on the U.S. economy and global financial system. This is the big question. If major countries like China and other BRICS members continue to reduce their dependence on the U.S. dollar and increase their gold reserves, could we witness a major shift in the global financial system? The U.S. dollar, once the dominant global reserve currency, could lose its leading role. This would have profound implications for the U.S. economy. Once the U.S. dollar is no longer the primary currency for international trade, America will face higher borrowing costs, reduced control over its economy, and a significant loss of financial power. The most immediate impact would be felt in U.S. government financing. Without foreign buyers absorbing a significant portion of Treasury issuance, interest rates would likely rise substantially. The Congressional Budget Office has estimated that each 1% increase in average interest rates adds approximately $250 billion to annual federal interest expenses at current debt levels. Higher rates would force difficult choices between tax increases, spending cuts, or accepting even larger deficits, each with its own negative economic and political consequences. American consumers would also feel direct effects from a diminished dollar. Imported goods would become more expensive as the dollar's value declined, reducing purchasing power and standard of living. The price of oil, still predominantly traded in dollars, would likely increase in dollar terms even if its fundamental value remained unchanged. This would raise costs throughout the economy, from transportation to manufacturing to home heating. The Federal Reserve would face a difficult balancing act between fighting resulting inflation and avoiding a recession triggered by higher interest rates. The financial system will have to adapt, and gold could once again become the intermediary asset in global transactions. If it's not just China, other BRICS nations like Russia, India, and Brazil are also ramping up their gold reserves and looking for alternative payment methods to replace the U.S. dollar. If this trend continues, we might be entering a new era in global finance where gold and other currencies replace the U.S. dollar's role. Russia has been particularly aggressive in building gold reserves, increasing its holdings by over 70% in the past decade despite Western sanctions limiting its financial options. India, traditionally one of the world's largest gold consumers, has formalized this cultural affinity by adding over 200 tons to its national reserves since 2020. Even Brazil, historically aligned with U.S. financial interests, has tripled its gold reserves in the past 5 years while simultaneously reducing its dollar holdings. Beyond gold, BRICS nations have been developing alternative payment systems that bypass the dollar-based SWIFT network. Russia's system for transfer of financial messages now handles over 20% of Russian international payments, up from virtually zero before Western sanctions. China's cross-border interbank payment system, CIPS, has grown to include over 1,300 financial institutions across 100 countries, creating a viable alternative to SWIFT for yuan-denominated transactions. These technical infrastructure developments make de-dollarization practically feasible in ways that weren't possible even a decade ago. So what happens if the U.S. dollar is no longer the world's reserve currency? Can America maintain its financial supremacy as major countries like China and BRICS members reduce their reliance on the dollar? The answers to these questions will shape the global economy for decades to come. The transition away from dollar dominance, if it continues, would represent the most significant change to the international monetary system since the collapse of the Bretton Woods Agreement in 1971. While such transitions historically occur gradually, Trump's threat of 100% tariffs could accelerate the process by incentivizing BRICS nations to develop dollar alternatives more urgently. For ordinary Americans, the stakes couldn't be higher. The dollar's reserve status has enabled decades of relative prosperity despite declining manufacturing competitiveness and growing trade deficits. If this financial advantage erodes, the economic adjustments could be painful and prolonged. Conversely, BRICS nations see in de-dollarization an opportunity to assert greater economic sovereignty and reshape a financial system they view as disproportionately benefiting the United States. As these competing visions collide, the resulting tensions will likely define international economic relations for the foreseeable future. #America in panic. Canada threatens to cut off power. America in panic. Canada threatens to cut off power. 1.5 million people plunged into darkness. Did you know that millions of Americans rely on electricity from Canada? And now Canada is threatening to cut off that power. Ontario, one of Canada's largest provinces, has just announced that it might halt electricity exports to Minnesota, Michigan, and New York. This means that over 1.5 million Americans could face an unprecedented energy crisis. But what has pushed these two neighboring nations to the brink of a full-scale trade war? And more importantly, if Canada actually flips the switch, what will happen to the U.S.? Let's dive in right now. The root of the conflict, a trade war, begins. It all started with a shocking decision in February 2025. Former President Donald Trump, after securing re-election, stunned the world by imposing a 25% tariff on all Canadian imports. His reasoning? Trump claimed that the U.S. had been subsidizing Canada for too long and insisted that the country play by new rules. This declaration immediately sparked outrage in Canada. Prime Minister Justin Trudeau refused to back down. Ottawa retaliated with a massive countermeasure, slapping $55 billion in tariffs on U.S. goods. The 25% across-the-board tariff represents one of the most aggressive trade actions ever taken against Canada, America's largest trading partner and historically closest ally. The move shocked policy experts on both sides of the border, with the U.S. Chamber of Commerce calling it an unprecedented assault on North American economic integration. Canadian officials were blindsided by the announcement, having received no diplomatic warning before Trump's televised declaration. Within hours, Canadian financial markets tumbled, with the Toronto Stock Exchange dropping nearly 8% in a single trading session. Trump's justification for the tariffs centered on claims of unfair Canadian trade practices, particularly in the dairy, lumber, and energy sectors. Canada has been taking advantage of American generosity for decades, Trump stated in his announcement. They sell us their electricity, their lumber, their metals, but when it comes to American farmers and manufacturers, suddenly they have all these barriers. That ends now. Economic analysts quickly challenged these assertions, noting that the U.S. actually maintains a trade surplus with Canada in many sectors, and that existing trade disputes were already being addressed through established USMCA mechanisms. But this dispute wasn't just about tariffs. How Canada is fighting back. If the U.S. disrespects Canada, then Canada has no reason to depend on the U.S. anymore. Step 1. Cutting off critical energy and resources, oil, natural gas, and electricity, all things the U.S. depends on from Canada, could be restricted. Ontario is considering stopping power exports to Minnesota, Michigan, and New York. If this happens, 1.5 million Americans could lose power overnight. The potential power cutoff represents Canada's most dramatic leverage point. The interconnected North American power grid has historically been managed cooperatively, with little consideration for national borders. Ontario Power Generation, the provincial utility, currently exports approximately 12 terawatt-hours of electricity annually to the United States, enough to power 1.5 million homes. These exports are particularly crucial during peak demand periods in the summer and winter, when the U.S. grid is already strained to capacity. A sudden termination of this supply would leave grid operators scrambling to avoid rolling blackouts in major population centers. Legal experts debate whether such a power cutoff would violate existing treaties and contracts. The North American Electric Reliability Corporation, NERC, maintains that grid operators have obligations to maintain system stability that transcend national interests. However, Canadian officials have identified emergency provisions that could potentially justify temporary export restrictions during periods of domestic supply constraint, a condition they could deliberately create by scheduling maintenance on key generation facilities. This legal ambiguity has heightened tensions and complicated contingency planning on both sides. Step 2. Seeking new trade partners. Canada is shifting oil and gas exports to Asia, especially China and Japan. In 2024, Canada completed the Trans Mountain Pipeline expansion, increasing capacity to 890,000 barrels per day, making it easier to sell oil without relying on the U.S. Canada is also strengthening trade ties with the EU and the Pacific region, signing new agreements. These moves have Washington deeply worried because if Canada is no longer a key trading partner, America will suffer severe economic losses. The Trans Mountain expansion represents a strategic pivot years in the making. Despite numerous legal challenges and environmental protests, the Canadian government persisted with the project precisely to reduce dependence on the U.S. market. Prior to the expansion, approximately 99% of Canadian oil exports went to the United States, creating what many Canadian officials viewed as dangerous economic dependence. With the expanded pipeline now operational, Canadian producers can ship directly to Asian markets where oil often commands premium prices compared to the discounted rates historically paid by U.S. refiners. Beyond energy, Canada has accelerated trade diversification across multiple sectors. The Canada-European Union Comprehensive Economic and Trade Agreement, CETA, has been supplemented with new protocols expanding agricultural access. Similarly, Canada has pursued deeper integration with the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, countries, with particular focus on Japan, Australia, and Vietnam as alternative markets for Canadian goods. Trade missions to these countries have increased 300% in the past year, with Canadian officials explicitly pitching their nation as a reliable alternative to unstable U.S. supply chains. The worst-case scenario: energy crisis in America. Imagine this. One night, New York, Michigan, and Minnesota suddenly lose power. Hospitals go into emergency mode, struggling to keep critical equipment running. Factories shut down, leaving hundreds of thousands of workers unemployed. Electricity prices skyrocket, affecting millions of American households. This could trigger a severe energy crisis, shaking the entire U.S. economy. The vulnerability of these states to Canadian power cuts varies significantly. Michigan would face the most severe impacts, as approximately 28% of its electricity supply comes from Canadian sources during peak winter periods. Minnesota's exposure is somewhat lower at 14%, while New York's overall dependence is around 6%, though this rises to nearly 20% in upstate regions near the Canadian border. Grid operators in all three states have begun emergency planning sessions, but industry experts warn that replacing this much capacity on short notice would be nearly impossible. Hospital associations across the affected states have expressed particular alarm. Modern medical facilities require uninterrupted power for everything from life support systems to electronic medical records. While hospitals maintain backup generators, these are typically designed for temporary outages lasting hours or days, not the weeks or months that might be required to reconfigure power supplies. The American Hospital Association estimates that approximately 320 medical facilities serving over 4 million patients could face critical operational challenges if Canadian power were suddenly cut off. But that's not all. Canada could also cut off essential resources including nickel, vital for electric vehicles and lithium-ion batteries, aluminum, essential for construction and manufacturing, uranium, critical for nuclear energy production. If these resources are blocked, American industries could take a catastrophic hit. The resource dependencies extend far beyond just electricity. Canada supplies 50% of America's imported aluminum, a critical input for everything from beverage cans to aircraft. Similarly, Canada provides approximately 25% of the uranium used in U.S. nuclear power plants, which generate about 20% of American electricity. Perhaps most critically for America's green technology ambitions, Canada supplies over 80% of U.S. nickel imports, an essential component in electric vehicle batteries that has no ready domestic substitute. Disruptions to these supply chains would cascade throughout the manufacturing sector, potentially idling factories and causing price spikes across consumer goods. The timing of this conflict is particularly problematic given America's push toward electrification and green technology. The Biden administration's Inflation Reduction Act allocated billions toward building domestic EV and battery production capacity, but these facilities rely heavily on Canadian raw materials. Industry analysts estimate that replacing these Canadian supply chains could take 5 to 10 years and cost hundreds of billions in new mining and processing infrastructure, time and money America doesn't have if it hopes to meet climate goals and compete with China in the green technology race. Who needs who more? This U.S.-Canada trade war has gone beyond just tariffs. It's now a battle for economic power. If Canada cuts off power, oil, and critical minerals, the U.S. could suffer massively. Electricity prices would surge, affecting millions of Americans. American industries would struggle without essential raw materials. But does Canada really need the U.S.? The economic interdependence between the two nations is profound but asymmetric. Approximately 75% of Canadian exports go to the United States, representing about 20% of Canada's GDP. Conversely, Canada purchases about 15% of U.S. exports, accounting for roughly 2% of America's GDP. These numbers suggest Canada has more to lose in an absolute sense. However, the strategic nature of Canadian exports, concentrated in energy and critical materials rather than consumer goods, gives Canada unexpected leverage. While Canada might face broader economic pain, the U.S. would experience acute, potentially crippling disruptions in specific sectors. Canada's economic resilience has surprised many analysts in the early stages of this conflict. Despite predictions of immediate recession following Trump's tariff announcement, the Canadian economy has shown remarkable adaptability. The Canadian dollar initially fell nearly 10% against the U.S. dollar, but has since recovered half those losses as international investors recognize the strategic advantages of Canada's resource-based economy in the current geopolitical environment. Canadian businesses have accelerated diversification efforts that were already underway following previous trade tensions during Trump's first term. Canada has new trade partners like China, Japan, and the EU. Global demand for Canadian oil and resources is increasing. So the big question now is, can the U.S. still maintain control over Canada, or is this Canada's moment to break free and assert its own economic independence? The reorientation of Canadian trade has been most dramatic with China. Despite historical alignment with U.S. foreign policy, Canada has pragmatically increased economic engagement with Beijing as U.S. relations deteriorated. Chinese investment in Canadian resource companies has increased by 180% in the past 2 years, with particular focus on critical minerals and energy assets. Chinese state media has explicitly framed these investments as part of a strategy to help Canada achieve economic sovereignty from American domination, messaging that has found receptive audiences among Canadians frustrated by U.S. trade actions. European nations have also moved quickly to capitalize on the U.S.-Canada rift. The EU has fast-tracked approval processes for Canadian agricultural products that previously faced regulatory hurdles, particularly in the dairy and meat sectors. European automobile manufacturers, facing their own tensions with the U.S. over electric vehicle subsidies, have increased sourcing from Canadian suppliers. These shifts represent not just economic opportunities, but strategic realignments, as Canada increasingly finds its interests aligned with a broader coalition of nations seeking alternatives to U.S.-dominated trade systems. Trump is trying to deny responsibility for the current economic situation and the ongoing political controversies, while his approval ratings are plummeting. Instead of facing the facts, he continues to blame the Democratic Party and stir up extremist movements like Dark MAGA. These actions not only reflect his political strategy, but also raise a crucial question. Can Trump maintain his influence, or will he ultimately be left behind in this fiercely competitive political race? This is an issue Trump can't avoid. The economy, unemployment soared. Millions lost their jobs and businesses, large and small, were forced to shut down. When looking at the facts, Trump can't continue claiming to be the greatest.